Welcome to Debt Matters, the UK debt collection and credit control podcast that turns the week's news into practical takeaways for anyone managing receivables, arrears, or recoveries.
Glad to be here.
Today, we have a really clear mission. We are examining the recent collapse of Market Financial Solutions.
Right, commonly known as MFS.
Yeah, MFS. So this is a UK mortgage lender that entered administration recently amid some very serious fraud allegations.
Which is a messy situation for everyone involved.
Extremely messy. And our focus is on unpacking exactly how a situation like this impacts the everyday mechanics of debt recovery. Because the reality of this case is far more complicated than a standard bankruptcy.
It really is a tangled web. And to see the sheer scale of the situation, you just have to look at the exposure of the institutional counterparties.
Oh, absolutely.
I mean, U.S. hedge fund Elliott Management currently holds around $200 million of exposure tied directly to this failed lender.
$200 billion, that is a massive number.
It is, and they acquired that position from Chetwood Bank, which is a lender that Elliott actually backs.
Right, so if we connect the dots there, you have a chain of capital stretching from a major U.S. fund flowing through a U.K. bank all the way down to a mortgage lender that is now sitting in administration.
Exactly. And for the listeners, this brings up some very uncomfortable questions for credit professionals about asset verification and collateral.
Okay, let's unpack this. How does a $200 million position even get built up and then suddenly just fall apart like that?
Well, it happens faster than you'd think.
As a credit professional, seeing that kind of figure attached to a single counterparty in administration, it forces you to look at your own portfolios. We are looking at a textbook example of how risk moves from the originations phase, where everything looks completely pristine on paper, straight into the chaotic reality of collections.
Yeah, that transition from origination to collection is where all the hidden friction suddenly becomes visible.
It really does.
Because in origination, the focus is entirely on growth. You know, sales teams are getting deals over the line, they're securing funding lines, they're expanding the loan book.
Everyone's happy.
Right, everyone's happy. But when a lender collapses under the weight of fraud allegations, the music stops, straight away. The collections and recoveries teams are the ones left holding the pieces.
And the environment changes overnight.
Completely. The rules of engagement you relied on yesterday just no longer apply.
Because in a normal arrears workflow, things are fairly straightforward. You have one creditor and one borrower.
Yeah, a one-to-one relationship.
Exactly. If that borrower falls behind on a payment, your team initiates the standard communication chain. You send the letters, you make the calls, maybe you negotiate a payment plan, or you just move to standard enforcement. It is a linear relationship.
It is.
But in an administration scenario, shatters that linear process entirely, doesn't it?
Oh, absolutely shatters it. The dynamic changes. The second administrators are appointed because they take immediate control of the entity. You are no longer just dealing with a borrower who is late on a payment.
Right. You're dealing with a much bigger machine.
You are now in a crowded adversarial room. You've got insolvency practitioners, you've got aggressive legal teams, and crucially, multiple other lenders who might be claiming security over the exact same assets you thought were yours.
Which is a nightmare.
Disputes arise immediately over the priority and ownership of those receivables.
Which means your standard playbook is effectively suspended. You can't just call up the debtor and demand payment when 3 other financial institutions are sending them the exact same demand letter.
No, you can't. The debtor is just going to freeze. They'll wait for the courts to tell them who to actually pay.
Which makes sense from their perspective.
That is the reality of it. In these moments, recoveries stop being a straightforward chase and settle process. They devolve into this drawn-out operation where you have to prove, trace, and enforce.
Prove, trace, and enforce. Break that down for us.
First, you have to prove you own the debt. Then you have to trace where the funds or the collateral actually are. And then you have to navigate a really complex legal maze just to enforce your basic rights.
And that takes time.
Huge amounts of time. If you look at historical UK administration cases, things like London Capital and Finance, or even going back to the European arm of Lehman Brothers, the sheer time it takes to untangle these webs is staggering. These legal stays can last for years.
Years. Wow. And that brings us to the core issues surrounding MFS, which is the specific allegation of double pledging.
Yes, the ultimate nightmare scenario.
For anyone managing collateral, this is the worst case scenario. It is the practice of using the exact same collateral more than once to secure different lines of funding.
Right.
Imagine having one car and handing the V5C logbook to 3 different pawnbrokers to get 3 separate loans.
The logbook analogy is spot on. What is genuinely terrifying here is how this illusion of security operates in the corporate finance world.
Because it all looks so legitimate.
Exactly. A lender might have a portfolio of commercial mortgages or receivables, and they pledge that portfolio to a funder like Elliott Management in exchange for capital. And on paper, the security documents look flawless.
They check out.
They have all the right signatures, the covenants are clearly defined in the facility agreement, the asset values far exceed the loan amount.
And so you just file those documents away in a digital cabinet and assume your position is protected. The registry shows your charge, the audits look clean. But the reality of double pledging only comes to light when the entire structure collapses.
Right, when multiple funders try to claim their collateral at the exact same time.
And this is why it matters directly to your daily operations as a credit controller or collections manager. When multiple parties claim the exact same asset pool, the real-world impact is immediate.
Very immediate. It leads to much longer timelines to convert that security into cash. You are no longer just selling an asset to recover a debt. You are fighting in court to prove you have the exclusive legal right to sell it in the first place.
You end up seeing a massive rise in legal stays. The administrators will freeze everything while they bring in forensic accountants to untangle the mess.
Which means your cash flow from those anticipated recoveries drops to zero during the investigation phase.
Zero.
Yeah.
And at the same time, your costs are spiking.
Exactly. You are looking at mounting solicitor fees, endless correspondence with insolvency practitioners, and ultimately lower net recoveries. The cost of untangling a double-pledged asset eats directly into the funds you eventually recover. The security you thought was bulletproof suddenly feels very fragile.
So what does this all mean for how we run our departments? Because in most credit control teams, we all obsess over KPIs like DSO and aging reports.
Right. Day sales outstanding.
Yeah. We track bad debt provisions meticulously to the decimal point.
But those metrics focus almost entirely on the end borrower. They measure how quickly your customers are paying their invoices or their mortgage installments. What very few teams measure, and what the MFS collapse highlights so clearly, is counterparty failure risk.
That is a vital distinction. We get so laser-focused on whether the individual property developer or the small business will pay their bill that we forget to ask what happens if the middleman collapses.
If a major lender, broker, or servicing partner fails, your ability to recover funds can be severely restricted. And here is the crucial operational reality. This restriction happens even if the underlying borrowers are perfectly up to date on their payments.
Wait, let's break that down. Are you saying you could have a portfolio of thousands of borrowers who are paying on time every single month, but if the entity servicing those loans goes into administration, those funds just get trapped?
Yes, because those funds are often routed through the servicing entity's accounts. The moment administrators are appointed, they freeze those accounts to figure out who actually owns the cash sitting in them.
Which takes a while to sort out.
Exactly. Is it client money? Is it the firm's operational cash? It takes time to verify. This is why measuring counterparty failure risk needs to be a primary KPI alongside your aging reports. You have to evaluate the financial health and operational integrity of the partners you rely on to route your money, not just the end borrowers who owe it.
Okay, so if we accept that this middleman risk is real, how do we actually prepare for it? We need to talk about protecting the receivables before a crisis hits. And a concept that keeps coming up is the proof pack.
The proof pack is your absolute first line of defense. It's about tightening up your documentation well in advance of any rumors of insolvency. For any account where you hold security, guarantees, or complex structured arrangements, you simply cannot afford to go hunting for paperwork after an administration notice goes public.
We need to be really specific about what goes into this pack. First, you need the signed agreements and any formal variations, and it has to be signed.
Yes, crucial point.
An unsigned PDF draft sitting in an email folder from 3 years ago is not going to help you when an insolvency practitioner is demanding legal proof of the contract.
No, it won't. And alongside the signed agreements, you must have an up-to-date, pristine statement of account. The administrators need to see exactly what is owed at the very moment of collapse. You also need rock-solid evidence of assignment if the debt was transferred to you.
Like formal notices of assignment and deeds.
Exactly. The chain of title must be unbroken and clearly documented.
But let me play devil's advocate for a second. In a fast-paced lending environment, who actually has time to maintain a pristine, fully updated legal pack for every single downstream partner at all times, is that practically feasible for a team processing thousands of transactions?
It is a heavy administrative burden, I agree. But it is entirely necessary if you want to get paid.
Because speed matters.
The overarching rule in insolvency is that speed wins. The creditors who can immediately hand over a flawless, comprehensive proof pack are the ones who get their claims recognized and processed faster. Those who spend weeks digging through archives or arguing over email threads end up at the back of the queue just burning through solicitor fees.
You also need the security documents and the registrations in that pack. It is not enough to hold a piece of paper saying you have a charge over an asset. That charge must be properly registered with the relevant authorities, whether that is Companies House or the Land Registry.
And finally, your proof pack must include a full payment history and a comprehensive communications log. This proves the ongoing nature of the relationship and can be vital if there are disputes about whether the debtor acknowledged the debt prior to the administration.
Okay, so if the proof pack is our baseline, what happens when we actively push back on the data we are given? How do we stress test a spreadsheet full of collateral?
You need to actively challenge your security assumptions. It is very easy to look at a system report, see a column marked secured, and feel comfortable. But you need to ask 3 blunt questions regarding those exposures.
Let's go through those questions. Question number 1. If we enforce tomorrow, what exactly are we enforcing against? This sounds basic, but it is often completely overlooked. Are you enforcing against a physical property, a specific piece of manufacturing machinery, or just a floating charge over a company's general assets?
You need to know the physical reality of the collateral.
Question number 2 is where the double pledging issue comes into play. You must ask, who else could claim priority over this asset? You need to understand your exact position in the capital stack.
Right, are you the first-ranking senior creditor, or are you sitting on mezzanine finance, that riskier layer of debt that sits below the main bank? Because if you are junior, the senior lender gets paid out entirely before you see a single penny.
And question number 3, do we have independent evidence that the asset exists and is unencumbered? You cannot just take the partner's word for it.
But again, this comes down to proportionality. You don't need to commission a third-party appraisal for a £5,000 unsecured loan, but for a £5 million bridging facility. You absolutely need independent valuations, official registry checks, and perhaps even site visits to verify the asset is real and free of competing claims.
Because the consequence of ignoring these questions is severe. If you cannot answer them cleanly and confidently, you have to assume the worst. In a crisis, if your documentation is weak or your asset is disputed, your secured debt will behave exactly like unsecured debt.
Which means you are fighting for pennies on the pound alongside the general trade creditors, rather than recovering the full value of your security. It is a harsh reality check for any collections team relying on assumptions rather than verified facts.
This is why proactive monitoring is so vital. You cannot wait for an administration notice to land on your desk. You need a lightweight watch list for the brokers, lenders, introducers, or servicing firms you partner with.
Building that watch list means looking for specific behavioral signals. The first signal is complaints and litigation. If you start seeing an uptick in public complaints, regulatory actions, or county court judgments against a partner, that is a glaring red flag.
You also need to watch for unusual funding changes. If a partner suddenly changes their primary banking relationship, or they start relying on expensive short-term funding instead of their standard facility lines, it usually indicates a cash flow squeeze behind the scenes.
Another critical signal is rapid growth paired with weak transparency. If a lending partner is doubling their loan book every 6 months, but they become vague about their underwriting standards or their funding sources, that combination is historically a precursor to a collapse.
And we also need to talk about borrower profile drift.
Borrower profile drift is a subtle but crucial indicator. This happens when the quality of the debt you are receiving starts slipping. Let's say your partner has always provided prime commercial property loans. Suddenly, you are seeing a wave of highly speculative, unconsented land developments in remote areas, complete with missing contact details and erratic payment histories.
Which means their internal standards have clearly dropped to maintain volume.
Precisely. Catching that borrower profile drift early gives you time to limit your exposure, pause funding, or tighten covenants before the partner completely fails. Risk management acting as a shield for your collections outcomes.
But when a failure does happen, you need to be ready to pivot immediately. Standard tactics simply do not work the second an entity enters administration.
You need a dedicated administration playbook ready to deploy. Escalation routes change entirely. You are no longer escalating a dispute to a team leader or a regional manager at the partner firm. You are dealing directly with insolvency practitioners who have very rigid legal protocols and who bill by the hour.
Settlement authority changes as well. The people you previously negotiated with no longer have the power to agree to a payment plan or a settlement figure. Every single decision has to be approved by the administrators, which alters your collections timelines drastically.
Your litigation strategy has to shift too. You cannot just issue a standard claim or statutory demand against an entity in administration. You are dealing with legal moratoriums and specific proof of debt procedures.
This is why the playbook is necessary. It dictates exactly who your team needs to contact on day one, what specific information to request from the administrators, and what evidence is required to lodge your claims accurately. It removes the panic from the process.
The big lesson to take away from the MFS story is a simple but powerful truth. Recoveries are strictly as strong as the chain of documentation and the physical reality of the collateral behind the deal.
Once that chain of documentation is questioned, or the collateral is found to be double-pledged, the entire process breaks down. Everyone involved ends up doing collections the hard way. It becomes vastly slower, heavily burdened with legal expenses, and fraught with intercreditor disputes.
It really does.
Here is a final thought to consider as you review your own counterparties and documentation this week. If the fallout from fraud allegations causes lenders to preemptively doubt the collateral of perfectly healthy partners, what happens to the wider credit ecosystem? Does the mere concept of trust eventually become a measurable financial cost of doing business?
When you have to spend capital to independently verify every single piece of data a partner gives you, trust definitely becomes a line item on the balance sheet.
Thank you for joining us today. Keep your proof packs ready, keep your documentation tight, and we will catch you on the next edition of Debt Matters.